Hi, good afternoon everyone. This is Mohit from Moneyfront. We welcome you all once again to this live Facebook session and with one of the stalwarts who have served ICICI Prudential Asset Management Company for last 14 years, Mr. Chintan Haria.
Thanks Mohit, thank you for
Welcome Chintan for coming on our Facebook live session, and this will be first of a kind. Chintan heads the product and strategy function at ICICI Prudential Asset Management Company. He's a chartered accountant by profession and has a very distinguished career with this particular asset management company. So without getting into too much of discussion on other things, I'll just get into the session. And for people who understand Moneyfront, just to highlight and reiterate that we are one of the leading direct plans platform on mutual funds. If you wish to know what is direct plan, how is it different from regular, kindly log on to our site and try investing with us. We also have a team who can help you with all kinds of recommendations and advisory. So here we go. Chintan, thank you for joining us.
Thanks, Mohit.
Seems like a good day to start our session, right? And I'm not sure why, but since the time we have planned this session with you, markets have just been going one way up. Any particular reason for this rally?
I'm sure it's purely coincidental, but if we see the entire emerging market space since January has been seeing a significant rally. In fact, India was the only market which was underperforming in January and February. Most of the emerging markets were up anywhere between 8% to 20%, and India was in fact down 2%. Now, why was India down? Obviously, it was India-specific factors. There were credit issues in certain companies. There was an election which was going to come whose outcome people were worried about. So I think combination of both of them held back foreigners as well as domestic investors. If you see the domestic investment flows in mutual funds had also slowed down.
Yes.
I think post 1st of March, or in fact post whatever has happened on the border, the election question probably is now lesser in people's mind. And also, let me put it this way, that FIIs who are holding back. In the last 15 days, we've seen gross inflows of close to $3 billion. That's close to 20,000 crores. Wow. This is the highest inflow in 5 years that we've seen in that 15-day period, which essentially has taken the markets to where it is. And I think today also it was an extremely strong move where Sensex is up 500 points odd as we speak. So that's the basic background. So I think what has changed is essentially the move from developed markets to emerging markets of FIs, and I think this trend will continue for another 3-4 years. And in India, a decisive trend breaker may probably come after elections. Till then, we will obviously see a up and down movement probably, and last 15 days have been good. I hope till May we see a good trend going ahead.
Very interesting 2 points which you make, and I'll perhaps go deeper into both the points. One is the point about emerging markets rallying all across, right? So that's the second part of my question. The first part, which is on the FII and the DII flows, right? Through 2018, we have seen domestic money completely flooding the market, which is where most of the retail investors have also participated.
Right.
And now for last 2 months or last 1 month odd, we've seen the FIIs coming back who were completely absent last 1 year. Why this change? And why has the domestic money suddenly evaporated?
So I think the easiest question as far as domestic money evaporating is concerned is people look at past 1 year's return and invest. If you see probably your own investors who are advised well by you, they may not be doing that. But most investors tend to invest when markets are high and tend to go away from markets or slow down when markets are low. It's the classic greed and fear phenomenon which affects everyone. It affects even the most sophisticated of investors. So the easiest part is essentially to answer your question, because markets haven't given good return in the last 12 months, post Jan 2018, we have seen possibly the flow slowing down in the domestic front, because people have been investing significantly since 2016, 17, 18.
Right.
So the incremental money probably is just waiting to find clarity based on the markets, and I hope last 15 days probably has kind of given comfort for investors to come and invest further. On the foreign front, if we see, this emerging market flows have actually picked up since end December, early January itself across the board. And for almost 12 weeks now, the emerging market ETFs have seen positive flows. Wow. So it is not something which is come overnight. Emerging markets have been seeing flows. India definitely, I think, in terms of flows, has seen a pickup in the last 3 weeks post whatever happened at the border.
Okay, for all those who have joined us now, this is a Facebook live session with Mr. Chintan Haria, and we're having an interesting conversation around what has suddenly propelled market. It's definitely not this session, but what he says is that the emerging market flows have improved for last 2-3 odd months, So perhaps Fed and ECB have a larger role to play in this rally. Do you think the easy money which has been flowing on will continue for some time?
So I think it is the change in Fed which was the significant game changer. If I take your viewers back to probably 2008-9 to 2015, that era was where the interest rates were coming down sharply in the developed markets across the board. You would have found zero interest rates in Europe, Switzerland. You would have found very low interest rates in US coming down to as low as 1.5%. That was obviously fueling the rally in the equity markets via the ETF route or via the investment route for most of these developed countries like US, Germany, Japan. That basically played out from 2010 to 2018. We've seen massive rally. In fact, today if you see US market cap to GDP is 150%. It's a $20 trillion economy with $30 trillion of market cap. That is probably the highest that they have seen in the last 20-30 years. Even in 2007 that wasn't the case. So developed market rally has played out. If we see since end 2015, the easy monetary policy of Fed has actually reversed. In other words, they have been increasing rates. And because Fed was increasing rates since end 2015, the emerging market, the dollar was appreciating. Because dollar was appreciating, the emerging markets were actually feeling the pain. And there was a culmination of the pain in 2018, wherein emerging market equity and emerging market currencies both fell very sharply. So what we are seeing right now is in some sense a reflation or a pullback, because now dollar has stopped gaining. US Fed has actually become very dovish. In other words, they are not increasing rates. And in a scenario where they are not increasing rates and US dollar is not becoming strong, the emerging market currencies and equities which had actually seen a sharp fall in 2018 are now bouncing back. So in India, we haven't seen that kind of a pain, at least in the large caps in 2018. But if you are an investor in any of the other emerging markets, be it China, or Korea, or Australia, or Turkey, or Brazil, you would have seen your investments get wiped off by 25-30% at an index level. That hasn't happened in India, and I think India is, and the reason for that is India is one of the strongest economies. It is a mature economy, it is growing, it is the fastest growing economy. And to that extent, because export-import forms only 2% of our overall basket or our GDP, we don't have to worry too much about these trade problems, etc. So India was strong in 2018, India will get the benefit in 2019, and I dare say for the next 10 years as well, India is one of the better markets to invest, and then FII money that is coming in is showing that.
Wow, so basically a lot of data points out there in whatever Chintan has said. I can't perhaps try and encapsulate everything, but one very interesting data point which you kind of mentioned was the US economy. It's a 20 trillion economy with a market cap of 30 trillion basically, right? Can you give us a similar data point for Indian economy? And because obviously you are mentioning that next 10 years is perhaps the year for India to continue the space. And
thanks, Mohit. That's essentially a question which I typically answer when people ask, is 2018 or 2019 going to be like 2008, wherein we are going to see a sharp fall in the Indian markets as well? So let me take your viewers back to 2008 itself, wherein US market cap to GDP was 130, our market cap to GDP in 2008 had reached a high of 160. So we were at market cap to GDP of 160% in 2008 beginning. From there we fell down to as low as 55%. Many of your viewers would remember that we had seen a 66% fall in Nifty. Compare that 2008 where there were no domestic investors at all. Like domestic investments was very low. FIs were actually ruling the market in 2008. Compare that to 2009. As a starting point today, our market cap to GDP, which is essentially the question which you asked, is as low as 75%. We are a $2.7 trillion economy today with a $2 trillion market cap. That $2 trillion would have gone up to $2.1, $2.2 trillion as I speak. In the last 10 days, we've seen a market rise. But essentially, we are still at 75 to 80% market cap to GDP, which is a 20-year average for India. So 20-year average has been 80. We reached a peak of 160%. Currently we are at 80, and I think given where the world is, given that the liquidity is reasonably strong, we are only a $2 trillion economy versus the world GDP of $85 trillion, and the world market cap is close to $75 trillion. So we are less than 3% of the global market cap with the population we all know as high as maybe 20% of the global population or 18% of the global population, and we are the fastest growing. So I'd say that the market cap to GDP is telling me that we are not expensive. In fact, it is a good time to invest from a market cap to GDP perspective. And I'm sure later on you'll ask me a question of then why is it not translating into a lower P and why is the PE high? But I'll allow you to ask me that question. Thank you.
Okay, so again, very very interesting data points. I think our viewers just need to note two important data points out here. US, which is a much more developed market than India. Keep in mind, it's a much more advanced and a developed market than India. It's trading at a market cap to GDP ratio of somewhere around 130 odd percent.
140 right now.
140 right now, and India is at 75 odd percent kind of a ratio. So there is a lot of leg room for investors to participate in the financial markets of this country. I think typically this gap is also because a lot of people don't participate in financial markets, and that is where the fresh domestic.
Yeah,
money
so
has
I'll
been
just
coming in.
answer that with another data point. India's equity investment, your and my savings total put together in India is about $7 trillion, out of which only 4% is in equities. The same number for US is close to 40%.
wow.
So we say Americans are rich. They are rich because 40% of their investments are in equities, in their own equities, while in India we have only 4% of our overall savings in equities, or close to 57-58% is in real estate, 13% is in gold, essentially bullion, and 27% is in other fixed income instruments. So clearly we are so underinvested in equities that, and yet because of our urge to keep seeing prices, and prices are every day in the market, we tend to give into greed and fear and lose out on the long-term opportunities. So equities is a perpetual long-term asset class. Don't look at it every few minutes and try and make decisions.
Oh, so again, a very interesting point, and I should perhaps bring out quickly on this one, Chintan, that I was just watching a Periscope session by one of the thinkers on Twitter. The guy is called Naval, and he has a very interesting video on how you can get rich. And it's just a 1 minute video, but all he says is you need to own equity, perhaps, in life. So again, coming back to that point and circling around that point, Indians are poor owners of equity, and that's an established fact, though that data point is changing consistently, yet there is a long way to catch up on that. Okay, so now that we have established a particular kind of a theorem, Chintan, which is that India looks pretty handsome from here on in terms of whatever you call the GDP market cap ratios and so on and so forth. There are two parts to it now. How do we look on valuations, which is pure earnings growth vis-a-vis what the market is factoring in? That's number one. And number two is, if this also kind of suffices, as in you say that okay, this number is also looking fairly attractive from a long-term basis, then what should Indians own? Should we stick to the normal large caps, or it's perhaps the time to venture out a little bit more and go for mid and small caps?
Right. So there are two questions to it. One is what are the valuations right now, and second is where should we invest incrementally. So on the valuations front, of course, right now on price to earnings, if you see the headline numbers, they will look expensive because for the last 5 years last 5 years we haven't seen earnings increase, because on different years we've seen different problems. The NPA issues has meant that the corporate banks have consistently reported NPA write-offs, losses. So these are past problems which are getting cleaned up right now. The metals have had a bad year since 2015, one of the bad years in 2015 because of China's slowdown. So that base became low.
Right.
And if we see in terms of the nominal growth in India itself, inflation has been low. So the conversion of GDP growth to profitability hasn't happened.
Okay.
We've gone through a transitionary phase wherein demonetization plus GST also changed the way Indians do business. And I think that platform has been well set for a good growth potential in the next 5 to 10 years. So if I look at past data on earnings, say on headline numbers, we're trading at 26-27 times PE, which may look high. But if I look forward PE, which is more a barometer because our markets are forward looking, it is supposed to be close to 18 times. Now, I don't know whether that is 18 times or 22 times. What I know for sure is India is going to grow at maybe 11 to 12% on nominally GDP basis. At least that's the trend which is being projected. And when we go 11 to 12% on nominal GDP, that should mean that the market cap to GDP, which I said should be anywhere between 75, 80, 90, can also trend higher along with GDP. So if you want to participate in the growth of India, in fact, just look at your own spending habits. You are spending more and more on many of the consumables which are listed actually, be it in telecom, be it on NTP. That's the question, where do we invest? So you invest across the board, and the best way to do it, or the better way to do it, is a diversified portfolio. So I'd say a multi-cap portfolio is something which your investors can look at. On the small and mid-cap space, I think SIP plus STP is something which is a good long-term way to invest. With your help, probably your US can take a more timing, tactical decision as well as to if they want to time the mid and small cap in terms of when they are very cheap, say in 2013, you can have a higher allocation. But probably that part I'll leave it to you because you are the best judge of the risk appetite of your investor, also the time horizon of your investor. So each investor has a risk profile and time horizon. The longer the better, and I'll allow you to probably take that decision on their behalf.
Perfect. Thank you very much, Chintan, and for all those who have joined us late on this session. This is a very interesting Facebook Live session with Mr. Chintan Haria, and we have been debating on Indian markets vis-a-vis global markets, perhaps US markets, and some benchmarks as to how markets look very attractive now. And I think for each individual, each investor, it's perhaps his own asset allocation, which is unique to everyone, and that's where we as advisors come into picture. You can come onto our site, you can do your financial planning, and you can set up your model portfolios as per your risk profile, and our team is always there to help you out with the right allocation. But tactically, what Chintan is saying is there are pockets which are looking interesting, and I think investors can take a strategic or tactical call out there. Basically, I have two varied questions on the Facebook Live session which is going on. One is when do you see, perhaps if that's the bullish view, when do you see markets touching a lakh figure? And then the second question is, do you still think that the Nifty PE level is alarmingly high, basically?
Okay.
So I don't know how.
I'll answer both the questions. Yeah. One on Nifty PE being alarmingly high. Sorry, it is again, like I said, ultimately it is a reflection of the earnings in the market, and last 5 years the earnings have been sub double-digit growth. In fact, it is a 4 to 5% growth in markets. Last 1 year, it is improving in line with improvement in NPA cycle in India, and it is expected to improve even further over the next 2 years. So while I can't crystal gaze in the future, what I know is for sure a lot of the NPA resolutions, courtesy the IBC, that is the Insolvency and Bankruptcy Code, would mean that the banking results will probably be better. And that's also being reflected, in fact, in the markets. If you see last 2 days back, I think Bank Nifty hit a lifetime high, and it has continued to be strong. So I'm just saying market is kind of reflecting that the future is likely to be better. Yeah. And what was the first other question?
That's an interesting one. When can you see a lakh?
So just to explain to your viewers, ultimately the Sensex is nothing but what earnings come in the market and what multiple do you give. So the earnings are a function of what the companies do, and the multiple is a function of liquidity. I guess when will 1 lakh come, I don't know, but ultimately if we keep rising as a country in terms of our GDP, at some point of time it will start getting reflected on the barometer, which is Sensex as well. When will it happen? Anyone's guess, but ultimately if we keep growing, it should come sooner than later. But timing I cannot predict.
Okay, I think we'll all stay away from the timing part of it, but I'm sure each one of us will see that mark someday. On that note, I turn towards the interest rate cycle, Chintan.
Right.
It seems globally and also in India that the rate cycle has turned, basically, right? How should one position more so in debt and also in equity, given where the rate cycle is? And also there is one question from Mr. Rahul Rai. Basically what he's asking is how should one play out interest rate risk in the debt fund? So it's linked to it, that's why I'm clubbing the question, which is what do you think of the rate cycle and where should one position incrementally on the debt side?
So clearly if we see India, it was probably an isolated case in the rest compared to the rest of the world. In most of the countries, emerging or developed, the interest rates actually came down very sharply. Right. And when I say sharply, in the last 5-6 years. India, except for probably the demon time, the interest rates have always remained reasonable. I'm not saying they were high or low, they've always been reasonable. They were never too low, never too high, except for probably aberrations around demon or when the RBI raised rates. So clearly, even if we see today with crude being where it is and FI money coming in, I think there is a potential for interest rates to soften further. Okay. Our view as a house is neutral on interest rates. So what we prefer in terms of investments is shorter duration funds, that is the 1 to 3 year bracket. And I think if you want to probably keep yourself immune to interest rate cycle, I think accrual funds are something where your investors can invest in. Stay invested for 3 years, ultimately you will probably get the benefit of higher yields which are available right now in the credit papers.
Okay, so basically just to summarize what Chintan is saying, that the house view is currently neutral on interest rates, which means though he personally kind of anticipates that it should soften, but it's not like we see a very dramatic cut. Am I
Correct,
right?
That's right.
Yeah. Okay, so given that scenario, I think perhaps what he's saying is accrual funds or shorter end of the curve, which is your short-term funds, perhaps your liquid funds, your low durations or your ultra short-term kind of basket looks a reasonable a catch to be basically on the debt side for people who want to allocate their monies in debt or want to do an asset allocation thing. A commensurate question with this one, Chintan. What do we do with corporate bond funds and credit risk funds?
So I would say that when fear is the highest in any category, that's probably the best time and the best investment that you get in that particular category. I guess if you can actually, as an advisor, advise them on what is it that you should look. So from our perspective, the due diligence that we do, the diversification that we bring in terms of even the due diligence that we do not probably take it on face value that whatever is the rating. We actually have our own process of essentially figuring out what is the potential for that particular corporate to pay back. And I think the diversification of the portfolio across the board and basically ensuring that return of capital is more important than return on capital in debt. So it's not necessary that we are chasing the highest yields when we are getting into different corporate papers. It is essentially the ability of the corporate to honor and also ensuring that you get a higher return. So in debt it's a bit different. In equities you do have the upside, in debt you don't. Hence it is better to play it a bit safe, and that's where we bring in diversification at the time of investing your investors' money itself on the debt side. So that's where you choose your funds very carefully, and I think I'm sure when you have your own due diligence on funds, you would be doing that yourself.
Perfect. So very interesting. That's our perhaps a consolidated view on the debt side. Even as an advisor at Moneyfront, we believe that one should ideally tilt towards the shorter end of the curve currently, given the volatility and everything, and given that the stance on interest rates is perhaps neutral across most of the leading fund houses. I switch back to one of the questions which is there from one of our viewers right now, Mr. Ravichandran Rajgopal, and he's asking, what sectors are looking attractive going forward?
Thank you for asking that question. So essentially, our house view is that in general, except for a few nifty stocks and maybe consumer names, rest of the market is reasonably priced.
Okay.
So let's say telecom, where we are probably consuming a lot as a country, and we've seen consolidation in the industry. Now it's just a 3-player market.
Yeah.
That's a space which we like and we are overweight. Pharmaceutical, we all are spending a lot more on medicines today, and I think that is only going to go up as our middle class affordability goes up. So that space becomes interesting. Power and utilities, if we see our own consumption of electricity, it is only going to go up. So power and utilities becomes a good space to be in. And banking itself, if we see, other than a few pockets within NBFCs, the entire corporate banking space, and the fact that there may be a shift of business from public sectors to private sector as well, means that the banking space can be a very interesting space for the long run. So there are enough sectors which one can invest in. When the capex cycle picks up, the entire capital goods cycle can also do well. And the most important, which is probably close to all of us in terms of owning cars or bikes, we've seen autos correct significantly in the last 6 months because of numbers, and there are various reasons for that. I'm not going into the reasons, but I think as they correct, they start becoming more and more attractive.
Right.
So that space also is something where an investor or where we can probably are looking to nibble, so that we can essentially participate in the India's growth story. India is already the 4th largest auto market and probably will become 2nd largest in the next few years' time. And I think we will consume more cars than what we are consuming, more bikes than what we are consuming.
So very interesting out here, and for all those who have joined us late, this is a Facebook live session with Mr. Chintan Haria from ICICI Asset Management, and sectoral view coming out from Chintan is perhaps going forward, corporate banks, private sector banks are looking attractive, autos, pharma, consumption driven sectors, utilities, electricity you said, which is perhaps a part of utilities, right? So those are a few sectors which are looking attractive. Any avoidable spaces?
Like I said, FMCG, which is essentially anything which is above 40-50 PE, unlikely to probably make you immediate returns. Mid and small, mid caps which have been basically held up because of their quality. So I think unlike 2007, where everything which was high quality, high ROC was actually cheap, and everything which was beta or cyclical was higher, we have a reverse situation right now wherein quality, not just in India, actually if you look at it globally as well, all the high quality names are trading at life highs, and their PEs don't matter. I mean, it could be 50 P, 60 P, 70 P. So Yes, India, courtesy the $2,000 per capita GDP that we've crossed, we are likely to see a consumption boom in India. But I think the prices more or less reflect that in the shorter run. So that's a sector which probably may not fall a lot, but it's unlikely to even rise.
Chintan, there is just sorry to interrupt on this. There is a slightly contra view in the market, perhaps, and few people hold that view. Is given the budget this time around, which has kind of given a massive cash dole down to people, ranging into the range of almost like 70,000 odd crores, which will go in the hands of farmers and salaried class put together for this entire year. Don't you think consumption per se will take up in the overall economy?
So I think the 75,000 crores odd, which is essentially the 6,000 rupees per month, which is 6,000 rupees per year, which is going in the hands of farmers with less than 2 acres or 2 hectares of land. I would say that is going to help the basic consumption push. What has been allowed to salaried or the 5 lakh limit or rebate which is there, that will help again basic a little bit above level basic, so maybe bikes, two-wheelers, etc. It's not likely that it's going to change our consumption pattern in a big way. So I would say that two-wheelers, what I mentioned, is probably a better way to play it. And it's not going to change the bottom lines of consumerage significantly. It is a push definitely, but it's not likely to change. And if you're already trading at 60-70 times, while they may continue to do well, it's a space where the risk is higher because your valuations are not in your favor.
Maybe markets have already factored in quite a bit.
That's right.
Prices.
There is a premium to quality which is already there. And probably you may not lose money, like I said, in that. But if you want to make money, sometimes you have to be in the cyclical part of the business as well.
Very interesting. And that's why we keep talking to experts like Chintan on this Facebook Live session. Just to understand whether markets has run ahead of expectations, are we in sync with expectations? And very interesting point which he brings out. It might look like a great story on consumption, but prices have already moved much ahead of expectations. It's anyone's take what happens going forward. But yeah, very, very interesting view. And one last question, though we are almost in the last lap of our questions, but I have one more question from one of our viewers who is there. And a very basic question, but a very pertinent one. And he's asking, why is infra sector doing so badly in a country which is supposedly a growing country, where infra is the biggest requirement, and governments after governments or whatever debates after debates emphasize that there has to be private sector capital investment and public sector investment. But infra as a sector is doing bad. Why
While I agree that some of the pockets within infrastructure, so there was an overeating in 2008 in infrastructure names, then there was a correction which happened, which was a massive correction. If you got into infra in 2013, you did make good money till 2015. Those companies within infra which had a balance sheet which was very stretched obviously never came back. So not just within infra, in any sector, if you find there are companies which are not handled well, they will probably go through a downturn and they may not exist. So that's exactly what happened in infra. When we had this boom between 2003, 2008, many infrastructure companies came up. Many of them don't exist today. That's a natural cycle of life of a corporate cycle. But what I would say is that within infra, if you see many of the good quality names, they are still holding up reasonably well. I'm not saying they've delivered massive returns since 2015-16. But I'd say that be it cement, which is a proxy play of infra, be it banking itself, which is essentially lender to infra, they are basically also seeing an uptick, and eventually when the capex cycle improves, you will find that infrastructure names do well. Having said that, there are many infrastructure names which have basically gone up 10-20 times in the last 5-6 years. So it's not like infra doesn't give, but yes, as an overall sector, it has been a muted sector.
So that's an expert take on infra. And on an overall basis, yes, every one of us agree that it hasn't kind of delivered those returns which investors was perhaps anticipating. But there are sectors which are ancillary to infra or which are perhaps linked remotely or like cement, banking, which support infra, aid infra, and those have done reasonably well and perhaps look positive from here on. Chintan, before we wind up this session, and it's not very often that we get to pick your brains, any last words of wisdom for the next financial year for all our investors?
So I'd say don't just look at it from the next financial year, but yes, one thing is very clear: asset allocation is your best friend, and don't ignore asset allocation, which I'm sure you will be guided on. But keep your asset allocation in mind. Don't keep changing your equity allocation every day. Don't look at prices every day. Equity is a long-term asset class. The longer you participate, the better it is. systematic investment plans are your best friend for investing in the long run. I'd say you can pick up any sector, any fund, it does not matter. If you have a SIP running for 10 years, 20 years, 30 years, you will ultimately get the benefit of compounding in equity markets. So remain invested, keep asset allocation in mind, use systematic investment plans for you and your family, and keep your investment journey continuing. Thank you.
Thank you very much, Chintan. And the last note from Chintan is perhaps worth taking back home, which is in the list of all your friends, make equities as one of your best friends. And thank you very much for joining us on this Facebook Live session. Thank you.
Thank you, Mohit.
Thanks, Chintan.